And it's very important to understand how ETFs work. They're very complicated. We did 3 years of research to understand the mechanisms in ETFs. And I'll make this very simple. I'll take those 3 years, boil it down to about 2 minutes. You have to understand, investors and traders, that there is a wholesale market for ETFs and a retail market. That is a product of exemptive orders from the SEC that permit ETFs to function differently than pooled investments under the Investment Company Act of 1940. So ETFs are created wholesale. A party like Morgan Stanley will create them 100,000 shares at a time, off market, in a block, commission-free, tax-free. And how this happens is Morgan Stanley will gather up stocks, a basket of stocks. It could be cash. It could be a cash substitute, cash in lieu it's called. And it will be worth a certain amount, let's say $10 million. And they will give that to ARK. And ARK will say, now you can create $10 million of ETF shares to sell to the public. And Morgan Stanley will want to mark it up just a little bit. And ARK wants to earn a fee. They want to create ETF shares. By the way, in November, $90 billion of new ETF shares were created. So far this year, $5.2 trillion of ETF shares have been created and redeemed. And every time that occurs, there's an arbitrage trade. So you and I as investors buy a slip of paper effectively. It could be my pen. I could tell you my pen is worth whatever is in my wallet. And so long as you believe that, my pen is traded as if it had equal value to what's in my wallet. My wallet could be empty. It could be full of cash. That's the way ETFs work. ETFs are a substitute for underlying stocks. ARK is managing a portfolio that belongs to ARK. It does not belong to you. You cannot go to ARK and trade your ETF shares and get this underlying basket of stocks. You would if you own a mutual fund. A mutual fund is required by law as a pooled investment to be redeemable. And all ETFs are exempted from that provision. Now, that doesn't mean the market is full of danger, but it's very important to understand that ETFs are derivatives. They're substitutes that trade in place of stocks. That's why they're very elastic. So we are valuing ARK shares as though it reflected a massive investment in Tesla, which it does, but the paper doesn't. That's an important principle to understand. The second piece of the puzzle is then, where do they get their prices? If they have no intrinsic value, how is an ETF priced? It's priced on perception and whether an ETF is above the value of the underlying basket or below it. And that mechanism encourages people to arbitrage the difference. And that works really well, so long as everything is normal. That's the essence of ETFs.